Good day, everyone. Today, we'll be discussing about investment in associate.
What is investment in associate? Before we dive into the topic, let us first discuss the terms that may help you understand our topic better. First is the intercorporate share investments.
Intercorporate share investment, the investing of one entity through the acquisition of share capital of another entity. Most of the investments are acquired for the purpose of accruing income through dividends and investment appreciation. However, there are cases where the entity purchases enough share of another entity for the purpose of exerting significant influence over the financial and operating policies of the investee entity.
To proceed, investment in associate, from what I've stated earlier, allows the investor to exert significant influence over the investee. Now, what constitutes significant influence? Significant influence represents 20% or more of the voting power over the investee.
Now there exist factors that evidences the existence of significant influence. Those are: first, the representation in the board of directors; second, participation in policy-making process; third, material transactions between the investor and the investee; fourth, interchange of managerial personnel; and last but not the least is the provision of essential technical information.
Let us also take note of the possibility of losing that significant influence, which can occur with or without the change in the absolute or relative ownership interest. Example of these cases are:
when an associate becomes subject to control of a government, court, administrator, or regulator. It can also occur as a result of a contractual agreement.
Now, since you are now acquainted with the important terms discussed in this topic, let us now proceed to the actual discussion or the measurement of the investment in associate. In measuring the investment in associate, we must use the equity method, which views the investor and the investee as a single economic unit. Please take note that under this method, the investor must have a significant influence over the investee.
Under this method, the investment is initially recognized at cost. The carrying amount of these investments is increased by the investor's share in the profit of investee and is decreased by its share in the losses. The carrying amount is also reduced by the investee's distribution of dividends. So, I repeat, under this method, the investment is increased by its share in the profits of the investee and is decreased by its share in the losses and is further reduced by the investee's distribution of dividends. So to further illustrate, here is an example. First transaction. X company, the investor, purchased 20,000 shares of the 100,000 outstanding ordinary shares of Z company, the investee, at 200 per share. If we divide the 20,000 acquired shares over the 100,000 outstanding shares, we'll get 20%, which is the interest of Company X over Company Z. Since it's 20%, it means that Company X, the investor, has significant influence over Company Z, the investee. And since we're using the equity method, we'll initially record the investment at cost, which is computed by multiplying the 20,000 shares by 200 per share, which would equal to 4 million. The journal entry for those transactions would be a debit to investment in associate of 4 million and a credit to cash of 4 million. For the second transaction, the Z company reported a net income of 5 million for the year 2017. To compute for the investor's share, we just need to multiply the 20% to 5 million, which is equal to 1 million. These amounts represent the investor's share and the profits of the investee. And remember that under equity method, that share would increase the carrying amount of the investor's investment. The journal entry would be a debit to investment in associate and a credit to investment income, both at 1 million pesos. The third transaction involves the investor receiving a 25% stock dividend from the investee on December 31, 2017. On this transaction, a memorandum entry is sufficient. Note that the receipt of these stock dividends will not affect the 20% equity interest of the investor. For the fourth transaction, the investee reported a net loss of 1 million for the year 2018. To compute for the investor's share on the loss, multiply again the 20% to net loss of 1 million, which would equal to 200,000. Opposite to the effects of net income, net loss decreases the carrying amount of the investor's investment. To record, debit loss on investment and credit investment in associate, both at the amount of 200,000. The last transaction involves the investee declaring and paying a cash dividend of 2,500,000 on ordinary shares on December 31, 2018. The investor's share on the cash dividends paid is 500,000, computed by multiplying 20% to 2,500,000. And to record that, debit cash of 500,000 and credit investment in associate also in 500,000. Note that under the equity method, cash dividend is not an income, but a return or a reduction of investment.
Another phase for the accounting of the investment in associate is when there is an excess of cost over the carrying amount of the net asset acquired. Examples of these are: an investor purchases 20% outstanding ordinary shares of an investee for 5 million. The investee at that date has a net asset of 20 million, and the investor acquired 20% of that, which is 4 million. The difference of the consideration paid of 5 million and the carrying amount of the net asset acquired, that is 4 million, is 1 million. Called is the excess of cost over the carrying amount. These excess may be attributable to the following. First is the undervaluation of the investee's assets. Second is there exists a goodwill. Going back to the problem, let us assume that the investee has a building whose fair value is 2 million greater than its carrying amount and has a remaining life of 5 years. Please take note that if the excess is attributable to the undervaluation of a depreciable asset, the excess is amortized over the asset's remaining life. Now, since the investor has only 20% interest, each share in the 2 million increase in the value of building is also only at 20%, or 400,000. Assuming that other than the building, all assets are fairly valued, the excess will now go to goodwill. Our computations will not end by just computing the goodwill. Since the excess of cost has an amount attributable to the undervaluation of depreciable asset, we must now compute for the amortized value of that excess. To do that, we must divide the undervaluation amount over the asset's remaining useful life. In our case, or in our problem, the 400 will be divided by 5 years, which would equal to 80,000. And to record that, it will be a debit to investment income and a credit to investment in associate at 80,000. Please take note that if the asset involved is a land, then it will not be amortized, for land is non-depreciable. And if it's an inventory, the amount is expensed when the inventory is sold. For the excess attributable to goodwill, it is not amortized, for it is included in the carrying amount of the investment in associate. Now what if it's the other way around? There will be an excess at the net fair value over the cost. Under these circumstances, it shall be treated as an income and will be included in the determination for the investor's share in the investee's profit or loss.
Another important topic that we must discuss is the upstream and downstream transactions. Now first, What is an upstream transaction? This transaction involves the sale of asset from an associate to the investor. It is important to take note that the unrealized profit from these transactions must be eliminated in determining the investor's share in the profit or loss of the associate. For example,
an investee sold an inventory costing $200,000 for $300,000 to the investor. By the end of December 31, 2017, the inventory remains unsold. The unrealized profit from this transaction is $100,000. Recall that under intercorporate transactions, such as an upstream, unrealized profit must be eliminated. Thus, the $100,000 must be deducted to the associate's net income for the year. Going back to our example, if the investee has $2 million income for the year, then it will be deducted by the unrealized profit on ending inventory of $100,000, which would result to an adjusted net income of $1,900,000. And to compute for the investor's share, $1,900,000 is multiplied by the 20% interest and would equal to $380,000. To record this, debit investment in associate and credit investment income of $380,000. Now what if in the subsequent year, the inventory was sold to an external buyer? The unrealized profit from this transaction would then become a realized profit and will be added to the net income of that year. Now assuming for the subsequent year, the entity has a net income of $2,500,000. The amount will be increased by the now realized profit of $100,000. So the adjusted net income is $2,600,000 multiplied by the investor's 20% interest would result to $520,000. To account for, let's debit investment in associate and a credit to investment income of $520,000. Another type of intercorporate transaction is the downstream transaction. These are sale of assets from the investor to an associate. Unquestionably, the unrealized profit from these transactions must also be eliminated. The accounting issue is how to eliminate the unrealized profit from downstream transactions. Unfortunately, PAS 28 does not offer crystal clear guidance on the accounting issue. This issue is still the subject of a discussion paper for an IFRIC interpretation. So for now, it is being interpreted the same as an upstream transaction. That would be the end of our discussion. Thank you for watching and listening. I hope you have learned something that would help you in your studies. God bless and have a good day.